TheoTrade. This is Don Kaufman. It's June 29th, 2019, and you are watching the TheoTrade Weekend Update. People, the first half of the year, it's in the books. This is the best first 6 months of the year since 1997. You gotta recognize that that headline is splattered all over the financial media. Up 17.4%. Again, 17.4% in the S&P 500 in 6 months. It's even more than that when you start calculating, like, look where we just came from in December. Of course, December, we're in the middle of a market meltdown over here. But you just have to ask yourself a question, and all of us have to kind of ask the question, markets, what are they trading on? Okay, I'm gonna give you my take. I think they're trading on an idea. They're trading on hope. They're trading on Fed rate cuts, trade deals, and the idea that the Fed is going to save the economy, right? I mean, what else can you actually attribute this effectively to? Are we getting stronger? No, we have earnings season coming up. It's right around the corner. Well, a lot of truth is going to be told specifically in that earnings season. But again, you got to think about this. I mean, the Fed, it's all about the Fed. Markets are just hopium at this point, because what positive ideas have really come out of not only the economy, but literally out of what's going on in the first 6 months of the year, right? I guess, again, the marketplace sees something that maybe we don't necessarily see in terms of how good can a 25-point basis, cut in Fed fund futures, is that going to save us? Well, maybe not, but I will tell you this. China, there's a trade truce. Why? The U.S. conceded on the Huawei portion of this, but anyway, this is already old news. It came out again last night, Friday into Saturday night. China trade truce, so we're through it. And the SPX, the expected move for this Monday, July 1st, is a $35 expected move. Again, a $35 expected move, higher or lower. So the market effectively priced a lot of this in. In fact, I'll give an argument that the marketplace already saw a lot of that upside potential. So Monday could be some interesting trade. Then we're going to kind of die out a little bit maybe on the week. Net though, this entire week holds about a $52, again, a $52 expectation of movement, which, people, it's big. I mean, we only have 3.5 trading sessions for this July 4th holiday. If you're not aware, Monday's a full trading day, Tuesday's a full trading day. Wednesday, the markets will close at 1 p.m. Again, 1 p.m. Eastern Standard Time on Wednesday. The market's effectively closed on Thursday for the July 4th holiday and will be open all day on Friday. So again, the entire week holds almost a $53 move, but a lot of that's front loaded, right? July 1st, there's $35 of expectation over here. Now, a couple of other thoughts. One of the things that I want to mention is just what the market effectively did this past week. So the S&P down minimally, right? The SPX was actually down about 10 points. The Nasdaq was a little bit lower, but the Russell was absolutely ripping to the upside. Why? The Russell is filled with regional banks. So the stress test came out. Here we're going to implicate the Fed again, right? The stress test came out. When I say the stress test, the Fed goes out, they check all the banks out, yada, yada, yada. They come out. Everybody pretty much passes their stress test with flying colors. Now, earlier this week, I actually talked expressly about the financials. We couldn't have been more dead wrong, specifically me, dead wrong on the financials. My expectations of this stress test, were that yes, the banks would pass the stress test, but are we not in a lower interest rate environment? Of course we are. I mean, look, the last 6 months as the market's skyrocketed, interest rates are coming down. Those lower interest rates put some more stresses, if you will, on the banks. And what I did not expect is that the regulators opened the floodgates for more stock buybacks on the financials, right? So the financials now go buy back their own stock. They can increase some of the dividends over there. Even some of the compensation is increased. Yet all of this on the financials is in a lower interest rate environment, which, once again, lower interest rate environment stresses the financials. Basically what I'm getting at over here, let's not hedge around it anymore. This is just a brilliant move upon the regulators. So the financials are going to face headwinds. I mean, they're running like straight on into gale force winds because there's a lower interest rate environment coming. But We can let them buy back their own stocks, increase the dividend. How we got into this issue in the first place, that's why there's stress tests. I'm going to leave that one aside a little bit. Yes, I'm a little angry about the financials. Last but not least, I'm going to show you a bunch of trade ideas here, but I want you to recognize something about some of the trade ideas. This last couple of weeks, I'm clicking the mouse pretty much to the hands bleed. That effectively means I'm trading a lot. And I'm trading a lot of in-out spreads. They are very, very back. They are in play right now. In-out spreads, they're back, baby. But when you're placing these in-out spreads, what you're going to find is that the skew of the marketplace is kind of dictating that we place more bearish trades. And I'm going to show you that here momentarily. Not only how to place the bearish trade, but why. And we're going to be highly selective because, you know, how many emails can I get? People like, I don't want to place a bearish trade. The S&Ps are up 17%. I get it, okay? But we're still going to find some nice kind of target practice and line up a few in-out spreads. And some of our bearish in-out, spreads have worked extraordinarily well. With that, let's get to it. Let's get to some of the charts, some of the trades. And again, we're going to show you a little bit specifically about these in-out spreads. All right, to some charts and trades we go. You know, I kicked off the video portion of this weekend's update talking a little bit about the overall performance of markets. But, you know, really I only kind of covered the S&Ps, which as I kind of highlighted again just a few minutes ago, you're up about 17% in the last 6 months. However, when you start pulling it up from the absolute bottom, I mean, listen, the upside is, well, it's even better than, of course, that 17% return. The returns are nothing less than stellar. And I question at this point, first of all, you have to question the entire rally. I think any trader, economist, anybody in the financial systems would have to see that, like, wait a second. So we're slowing down. You go, yes. Global economy is slowing down. Yes. There's trade wars everywhere. Yes. Okay. There's geopolitical risk and there's tensions in the Middle East. Yes. What should the market do? Oh, it should rally. I mean, again, all of this is about rates. And, you know, I've always mentioned just a tremendous amount about bonds, but all of it comes down to right here. Well, you know, I'm on the 10-year. Obviously, this is not the Fed fund futures, but the 10-year people were at 2%. Now, again, I was actually calling for that 2%, okay, all the way back here in March when the yield curve initially inverted. But my expectations, okay, were this. I was expecting the interest rates to come back down because the S&Ps were going to be in trouble. Again, you have to sit back once in a while and be humbled a little bit by markets as a trader, as an investor, to see a 17% return. Now, I can say this, and please, this is being recorded, so I can say this. I don't think that the second half of 2019 is going to be nearly, okay, as, well, good, if you would, as the first half. Effectively, what I'm saying is I don't think you're going to see a 17% return, okay, in the S&P in the second half. And I can say that with not necessarily certainty, but a very high probability, given the fact that since the inception of the S&P 500, I mean, how many times has the market returned like 34+%? You can pretty much count them like on a hand. One of those is actually all the way back after like the 1929 crash. Let's not even go there. Nevertheless, I wouldn't have that upside. You know, there's just not that upside capacity. And I wouldn't have that in the back of my mind that the returns are going to be the same as the first 6 months of the year. But, you know, that's just the S&Ps. How did the rest of the marketplace fare? If you take a look at the QQQ, it's up about 20%. But let's look at the Russell, because you guys know I look at the Russell. It's on the forefront of a tremendous number of moves in this marketplace. And I say that because it's filled with financials. And the Russell was the underdog, but it kind of played catch up a little bit. Literally in the last 2 days of the quarter, okay, we exploded to the upside. But again, all of that was kind of predicated on what's going on specifically inside of the financials.
The financials, though, also lagging up about 15%. Again, I wanted to just throw a couple of different sectors out here. The financials are arguably the largest of the sectors. Now, again, everybody, it's tech, it's all about IT, it's all about the financials. Without the financials, the S&Ps just can't get the returns. Now, not talking about the Nasdaq, but the financials, yeah, they pretty much run the roost over here. It's about a 15% upside move in the first 6 months. And again, you have to sit back and start to think about what's really gone on. Lower interest rates, those are bad for financials. Okay. Every headwind that could be thrown the financials way has been thrown, and we're still up about 15%, which, I got to tell you, moving forward to the second half of this year, I like it. It's going to be on the edge of your seat the entire time. All right. So again, rates going lower, the market's trading kind of on a wing and a prayer, but specifically, they're really trading on, this is all about a 1/4 point cut. Maybe we get another cut kind of later on. All right, let's push that all aside. We're even going to push the financials aside just for the time being. So we saw a trade truce, okay? A trade truce happen overnight. So Friday night, Saturday morning, here we are on Saturday morning, of course, recording this video. Trade truce happens. So what do you expect the S&Ps to do? Now, whenever I ask that question, okay, my answer of what do I expect the S&Ps to do, on Monday morning, my answer is always going to be found in expectations. Like, what does the market anticipate? And there's a few things that leave me a little bit on, again, the edge of my seat on this one, as well as what's going to happen on Monday. I am questioning, was all of this priced in already? I think you should question it as well. Look at this. All right, we're coming to the cash close. I mean, we've got minutes left. I got to zoom in on this one because it caught me off guard. I got to tell you, I looked at the marketplace. I got to zoom back out because it was that kind of chaotic. We were trading in like a 2-point, maybe a 3-point range for most of the trading session. So I did like any good trader would do. It's a Friday afternoon. We're coming into a holiday week. I packed up my stuff, headed up north, and I'm driving and I'm like, in the last 12 minutes of the trading session, we moved from roughly 36, okay, right up to about, again, this is in the after hours, all the way up into about 55. That people is what we call almost a 20-point move in the S&Ps in, I guess if you want to count the after hours, almost 20 minutes of trade. So a lot of that move maybe got priced in. But if we take a look back at the SPX, and this is, it's getting a little crazy, a little bit alarming on this front, because we're going to go back to the SPX, and I want you to see the July 1st SPX expected move right there. You're $35. So on Monday, we're expecting a $35 move. You're like, whatever. If you don't know about expected moves, you should know this. All of last week, we were expecting just about a $45 move. That's the entire week. And last week, come on, we were kind of rocking a little bit. We laughed or cried. We had some volatility in there. I'm just backing up to last week for a second because the marketplace was rocking. That kind of risk is all packed into Monday. Now, again, everybody has this anticipation. Listen, trade truce, okay? How could they come away with anything but a trade truce out of this thing? And maybe you think the market's going to spike. If the market does spike, I'm going to tell you, I'm going to look for some reversal in that trading session. I'll remind you again, July 1st, a full trading day. July 2nd, a full trading day. July 3rd, right? They're going to cut that day short. But July 5th, okay, Thursday we're closed. This is July 5th. This would be none other than Friday. You still have almost a $53 expectation of movement, which in 3.5 trading days, this is a more substantial, and again, I want to really highlight this, it's a more substantial expectation of movement than we've seen in any of the recent weeks, right? So how ironic. Now, after we get through this, the trade truce, okay, listen, there's going to be some movement. This summer, people always talk about it's the summer doldrums. You don't have to worry about the markets, okay? I'll counter with this. This summer, thus far, this marketplace, this thing's been rocking. I mean, obviously the month of May, precipitous sell-off, followed by, the smoke and rally to the upside. For a summer trade, sure seems fairly volatile to me. But you have to redefine what you think volatility happens to be. The VIX, again, I always say this, it's my predecessor's indicator over here. The VIX remains, okay, leveled out somewhere in the 15 range. But let's also talk about the broader markets for a second. I'm still carrying negative deltas, which effectively means that on duration positions, I've got some bearish positions. But I am, I don't want people to believe that I'm not outright short the S&Ps. People, again, they get this all misconstrued. I'm not short, okay, the spiders in the midst of this wild run-up. Again, specifically, if you want to get into the wild run-up, we were up 10%. This is what, 7-10% run. I'm not short the spiders. I'm highly, highly selective into products that I am short. Nevertheless, okay, I am taking a little bit of a hit as of yesterday. I'm short some of the financials. Okay, the financials, though, hey, the truth is okay, is gonna be coming because, well, we've got earnings coming up. And again, I just wanted to highlight this specifically in JP Morgan. You've got earnings coming up. Hey, we're 2 weeks out from earnings once again. Nevertheless, I still carry some short positions, and a big portion of me, and this is kind of what I've wanted to hammer home to you, a big portion of me, and I carry short positions in negative deltas. I look at a position like this where the S&Ps, they're poised right at their all-time high. It's all right. Got a gravity point at 29.11. We haven't hit it now, a couple of days. Nevertheless, a big portion of me says, let's just get this done. Let's just head to 3,000, like off like a Band-Aid, so that as traders, we can move forward a little bit. I love the market's two-sided action. Just because I'm carrying negative deltas, okay, isn't per se a bad thing. Okay, I've had unbelievable roll opportunities in the month of May. I'm taking some heat in June, but June, it allowed me to get back into some positions. And now I'm actually going to deviate for a second. I'm going to show you, okay, why I'm taking some of the positions that I happen to be. So let's cruise back over to the spiders for a second. Let's open up an option chain. So typically when I do these weekend videos, I don't get like intimately trade specific over here. I have tendency to talk just in general about the markets, but there is a big portion of this marketplace that's kind of weighing on me as a trader. When I say it's weighing on me, there are times when the marketplace kind of forces your hand, and this is one of those times. Okay, if we look at the spiders now, we're going to look specifically at the option chain. We're going to come over here. We're going to go from options, theoreticals, and Greeks, come down to none other than implied volatility. What I want to show you in here is I don't mind taking some bullish trades every now and again. In fact, there's a lot of opportunities on the bullish side. However, if you're going to trade options and you want to remain relatively defined risk, okay, the issue is people, first of all, talk about selling options. I'm not comfortable selling a 14.8% like volatility in the spiders with 27 days to go to expiration. Why am I not comfortable with that? Because I've seen things, okay? I've seen the expected move get decimated, time and again, decimated here. So it doesn't exactly, I'm not enthusiastic because the actual price movements in the market in a lot of cases are exceeding what the implied volatility is paying me to take that risk. Basically what I'm saying, the juice ain't worth the squeeze. The other thing that is, I think, like weighing heavily on me, if you sell options here, you got to sell like a 13 vol, then you come out here and you got to buy like a 13.8 vol. You're like, whatever, man, it's like 0.7 or 0.8% difference. That's big. That's really big. The skew is still very, very prevalent, even though like if you measured skew, the skew is not that extreme. The skew though at the near the money options is big, right? And that puts you in a deficit. Like selling this put spread, I'm sorry, it ain't worth it. It's a $2 wide put spread. What am I going to collect? 50, maybe 60 cents? Forget it. There's just too much risk on the back end of it. So then somebody says, well, maybe go out and buy a spread. Well, here, we're trading right at 293. Okay, I can go out and buy, look at this. The 293, by the way, we kind of spiked up again after. But after the market closed, it kind of spiked up. So the 293, for instance, 295 spread, here's a $2 wide spread, and that $2 wide spread, okay, is trading for $1.25. Now, the option market, again, you can see in the aftermarket, we kind of bid up a little bit, but the at the money option is effectively right here. This isn't even, it's an out of the money spread. I'm buying the, one strike here, another strike there. It's $1.25. It's like an in-out spread, but you got to pay $1.25 for it. And you're like, wait, what are you saying? Okay. If you look at the price of the call spread, and then I'm going to throw up another spread in here, and I'm going to come in and I'm going to price the exact and opposing spread to it. And I've done this, okay, before, and I'm just going to price the put spread right next to it. I want you to see the differential, okay? And listen, if you don't completely understand about skew, and this is 13%, this is 13.8%, good, push it all aside. I think the best way to display this to you is just simply throw up, okay? What? Throw up a call spread, okay, which right here happens to be the bullish trade, and right below it is a identical but bearish trade. The bullish trade cost you $1.25. The bearish trade cost you 77 cents. Okay, what would you rather do? By the way, the bearish trade's actually in the money. I mean, I'm taking the bearish trade. That's it. And there's no if and or but about it. You're like, but I'm so bullish. When you're so bullish, you can't put directional bias ahead of trade logic. You can't put directional bias ahead of they're charging you more to get bullish in this marketplace. So you have to be a little bit innovative. Okay, you do. You have to be a little bit innovative. You have to go out there and you have to find spreads that, like, hey, what do I think is going to go down? It's okay to price that in. One of them that I'm looking at right now is like the emerging markets, the EEM. In this particular case, it's not about the run up in the EEM. Yeah, sure. The EEM has had a nice explosion to the upside lately. When I put up the auto expected moves, we cracked expected move here, hit the expected move there. We're outside the expected move, but this is not like a stellar move necessarily to the upside. Okay. But a lot to do with the dollar right now. Okay, a lot to do with the dollar right now. I am going to take a bearish in-out spread, and I'm going to go some 34 days out. Once again, though, I am going to absolutely use a bearish in-out spread, and I'm going to show you exactly why. If you take a look, and I've already placed this trade, some of the strikes that I've got on, right? I'm out there buying like an 18.4 vol and selling a 22.8 vol. Plain and simple, the volatility skew is so very much in my favor. Look at this thing. I mean, you got a spread, okay, that's nice. It's in the money. We laugh, we cry. You got a spread that you're paying pretty much intrinsic value for, 67 cents for a $2 wide spread. Whereas if you looked at that call spread, oh, I don't even want to pull this up. It's just going to be, oh, it's hideous. Don't look. The call spread is priced. I mean, it's not double, but it's pretty close to it. Again, keep this in mind, because everywhere you look right now, I mean, you'd be like, well, what about something like Apple? And I use Apple as kind of like the mainstay. First of all, Apple, you got to be careful. There's earnings coming up the end of July, right? I saw that immediately when I pulled up the chain. You can actually see the implied volatility already jumping a little bit in there. So you got to come in a little bit more shallow in terms of time, but the skew differential, it's there. And like, listen, it's in pretty much every single product. If you're going to be bullish, you're going to be buying what? A higher implied volatility than you're selling. If you're going to be bearish, okay, you're buying implied volatility of like 27 at least, okay, selling implied volatility of 27. All right, the skew in there is effectively flat to the downside. Trading right now, okay, is challenging for people because you have to go beyond what you think this stock is going to do, beyond what you think that this index is going to do, okay? It's not about movement. Why am I carrying negative deltas? Oh, I don't know, because I'm bearish in stocks like Boeing, right? And I want to be bearish in a stock like Boeing. Not every day is going to be necessarily a good day when you're bearish. And you can see I've got multiple positions inside of Boeing. Not every day is going to be a good day when you're bearish in a stock like Boeing. But net, this happens to be a duration position. That's why I'm carrying negative deltas. I'm still carrying negative deltas in Caterpillar. Do you know that Caterpillar was one of the top performers, okay, inside of the marketplace, specifically this last quarter? I'm still bearish in here. Why? Well, look where I've come from. Look where I've come from in here. 18 months, this stock is still down. Who cares if it's the upper end of the channel? I'm carrying bearish deltas because for me, that's where I want my dollars to be. Okay, and it's not all bearish trades. I still got some long positions mixed in over here and there, and I'll even take you through some of those positions coming into Monday morning. Nevertheless, I'll remain with my negative deltas moving forward, okay, and watching markets effectively trade in what I can call a Fed-fueled fantasy. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.